guys? Welcome to the Chris and Caleb Team Live show that we're going to do every month on the second Friday of the month. I've got my trusty business partner here, Derek Ryan. Derek Ducky Ryan, how you doing?
Good. We're good.
You're about to go on vacation.
I am. Going to the cold, North Dakota.
That's right, I forgot. For some reason I thought it was like Aruba or something along those lines.
Yeah,
but,
yeah,
you know.
North Dakota.
Yep. So, yeah, you're going to go hunt some duck and get some duck hunting.
Everybody pictures like a North Dakota vacation of like a bunch of guys just like throwing beer cans around and stuff, and in reality you're just like sitting in the cold.
Yeah.
You're just like literally sitting there.
How's that for an intro? Anyway,
Oops.
Obviously it's all good. We're the Chris and Caleb team where we're committed to dramatically impacting lives through real estate. And here's what we're going to talk about. There's some pretty big news happening with the market. If you get our newsletter, you got that last week, I think, or sometime this week. The softening, the shift, the market is changing. So we're going to talk about that. He's going to talk a little bit about what that means for buyers. Here's how we know that the market is shifting. And I've been talking about this for the last probably 2 years, because 2008 was the beginning of the last shift, and we're at 2018, so it's 10 years. And you measure markets from peak to peak. So the peak, we believe, was this summer, and so that's 2018 to 2006, 2007, depending on around there. So we're like 11 years into a cycle that should last historically about 7 years. So why do I say things are shifting? Well, the days on market are down. We went from
Days on market are up.
No, days on market are up. Thank you.
Yeah.
That's why I have him here. He's the smarter one. So days on market are up. So that's increasing. And the inventory accumulation is the real story. If you look at our blog, which has the data on there, the inventory accumulation has gone up pretty dramatically. In that we're going from like less than 3 months to like it went up about a month and a half, give or take. And in addition to that, our list to sale price ratio dropped. That's the one that dropped, not days on market. So from May to July, August, we saw a 98% list to sale price ratio, which meant that sellers were getting 98% of their asking price overall in Chester County. In places like Downingtown or Westchester, they're getting more. Which,
Phoenixville, Downingtown, Westchester, Great Valley. They're getting like 100% usually.
Yeah,
or
more in some cases.
Yeah,
depending. So that's changing. It dropped 2 percentage points from 98 to 96, which 96 is still really good, but it's a good shift. It's like when
in 1 month.
In 1 month, yeah, from August to September, and we kind of feel like it's that crest on that roller coaster there that we're seeing.
So in layman's terms, essentially homes are on the market for longer, which is what he was talking about, like inventory accumulation.
Right.
It's taking longer to sell. And then they're getting less for what they're asking.
That's right.
It's dropped, and so sellers are selling for less, and it's taking longer to sell.
Right.
Which are leading indicators of something changing, essentially.
Exactly. So, and I'm messing around with the camera and messing us up here. So, anyway, so tell me, you're on the front lines of buyers, right? You're on pace to sell 50, 60, whatever buyers this year sides and represent 50 or 60 buyers, which is crazy. So you have a really good insight on what's happening with buyers right now. Talk to me about what's changed in the last couple of months.
Yeah. So I guess one quick example. I think this March I wrote 12 offers. That month, the month of March, meaning I had people that wanted to buy a house.
Yep.
Wrote an agreement of sale, submitted it, and I got 2 under contract out of 12.
Holy cow!
Yeah, which is kind of crazy, and because every single one of them was a multiple offer situation.
Yeah.
And while now you might write 4 offers equivalently and get 3 under contract, or which would be like 12 and getting 9 under contract. For me right now, that's kind of what it looks like.
And don't misunderstand, it's not like you're bad at writing offers. The reason that so many got rejected was because there was so much competition, right?
I had somebody submit an offer that was at or over the asking price in a competitive offer situation. And so they're offering top dollar, and then the competing offer, they actually offered slightly less, but they had more money that they were making and then had more money saved that they showed the seller on a document. And so they actually went with that offer. So like you said, it wasn't like we're writing bad offers, but everything was so competitive that the sellers had plenty of options of who they wanted to select.
Yeah.
So
now, you're submitting less offers, but more are getting accepted. I mean, what are the conditions for that are affecting buyers? Like, what's that look like for the buyer now?
Yeah, so one of the big ones, I guess, is like interest rate. So interest rates are creeping up. Like if we rewind a year, they were roughly like 4.25, something like that. Right now, they're pretty close to 5.
Yeah.
And so what that means essentially is a larger monthly payment for the buyer.
Right.
That's really what rubber meets the road, what that comes down to. And so if somebody was like on the cusp of qualifying for a certain type of home that they wanted, well, now some buyers, it's harder to find that type of home because the payment's larger.
Right. That's right.
And it's uncomfortable. Who wants to pay more?
That's right.
So people are getting pickier. Homes are lasting longer. And because the inventory is increasing, the nicer things, they're still selling quickly, in my opinion. They still are.
They are, for now.
There's still people out there looking to buy. And the nice things are selling. And so the things that are really left over, aren't as nice. And so it's just harder to find a home that you really like.
Yeah, folks, you're not going to feel that. You're not going to feel the shift or softening in the market just yet. It's happening right now. And in September, our team and a bunch of other top teams in the area that we talk to regularly, we're feeling that. They're like, man, September is way softer than it was last year. And here's the thing for buyers, with the interest rates, what you got to understand is like if you're conservative, let's say, and you don't want to, they'll approve you up to maybe 40% of your debt to income ratio.
I've seen people go as high as 51% sometimes, which is wild. So it means,
it is wild.
In other words, if you're bringing $100 in a month, the lender is allowing you to put $51 a month just towards your mortgage, not including utilities or food or anything.
Which is your choice. However, our conservative financial folks would say 25 to 30% is probably good. Let's say you're in that camp, and it's like, okay, at 25% of my debt to income ratio, I can afford a $225,000 home last year. Well, now you might be more closer to 200 because of the interest rates creeping up and things just not being as affordable as they were because your payment's increasing. And if it's like a $50 a month difference, I mean that's $500, $600, $700 a year extra that you're spending because interest rates have crept up and you waited.
500 times 30 is what, 15 grand, something like that.
Sure.
They're paying more
Whatever
over the life of the loan. So
yeah.
just because of an interest rate change, that's a big difference.
That's right. So, and for sellers, here's what this means: is that things are selling quickly still. Yet in the next couple of months, you need to have somebody that is studying the market. If you're on the market, your realtor better be studying the market every single day and know exactly what's going on. Because what will happen is, you think you're at a good price because you're looking at 3 to 6 months ago. You put your market put your home on the market at a certain number. Let's just say 300,000. Let's say what you don't realize is that really the market's at like 285 now. And then 30 days later, you're like, man, I thought this would sell for sure. And the price has dropped to 275. So you dropped to 290. You're still behind the ball. And it's like chasing a soccer ball down a hill. You're not, until you run and get in front of it and make a big jump to get in front of it, you're not going to sell. And so
it's a great analogy. That. I mean, that's for our clients. I mean, this is like real life. Like this is like actually happening.
This
like
money on the table.
Yeah, it's like literally happening right now. And so when we have, our clients towards middle to the end of the summer, maybe they were thinking like, okay, we're going to price it, like you said, in front of the market, and all of a sudden it's going to be multiple offer situation. We're going to sell. It's going to be awesome. Well, in reality, we might have actually been a little bit late.
That's right.
In at least, or we just priced it a little too high. So then you're here thinking it's going to go here, but you're actually here and it's already going down.
That's right.
And so it's like there's a disconnect.
There is.
So
and look, the truth is that most realtors are not studying the market daily like we are, and they're not going to know this for another 6 months probably. They're not going to realize that because, it's just seasonal, it's just slower, whatever, and it's like, no, you're going to lose. There's a home that when I first got in the business, they were legitimately worth $650,000 a few months before they listed it, and what they didn't realize is, and they were a little stubborn on price maybe, they ended up selling like a year and a half later for $450,000 because they chased the market down. They didn't get ahead of it. And that's what we're talking about. We don't want our clients losing that kind of money. Yes, it's going to hurt to make that big price drop, but you got to get it in front of that. And the only thing that's going to tell you whether you're priced right is it actually sells. It's really it.
It's a really, really hard conversation to have. It's a very hard conversation.
Awkward and uncomfortable.
Because on our end, it comes off that we're very bold, brazen. If we say, hey, price drop, you should drop $25,000. We priced it too high. We need to get in front of this, and it's like, whoa, like that's a lot of money.
Right.
And then at the same time, we want to protect the client's dollar, and so it's like, you know, I'm slightly hesitant in saying it,
That's
and
right.
yet
We have to.
Yeah.
If we're looking out for your best interest, we've got to be truthful and honest, and we've got to share that with you.
yeah,
So
it's hard. It's hard truth.
it is.
So you want to do
Shift gears?
Yeah, some
Let's-
value adds.
So for the folks that follow us, that are our fans, that are past clients, we want real estate investing is something that is very close to our hearts. He's bought at least one or two this year, and I have a few investment properties, and it's an investment that, despite what's going on, makes a lot of sense. And so we wanted to share about 8 principles with you that are from a course that we've taken that really talks about how real estate is the most able investment, if you will. So
Yeah. So number one
is it's accessible, right? Almost anybody can buy it, right?
Right. You don't necessarily need money to buy real estate.
What?
I know, it's a crazy thing. I have a coach, and he was telling me that when he first got into investing in real estate, and I don't know how many dozen properties he has now, but he found somebody that was not happy with the return he was getting on the stock market, of a wealthy individual, and he went to that person and said, "Hey, if I can find you a property that can give you more return, we'll split it 50-50. You put the dollars in, I'll find the property, I'll manage the property, I'll do absolutely everything else. You just have to provide the funds."
That's right.
And so I think he said they bought 14 together, just that duo there.
Wow, that's awesome.
And he didn't put any of his own dollars into it. A lot of effort, a lot of sweat, a lot of time, but you don't need necessarily money, so it's accessible.
Number 2,
it is appreciable. I think it's a funny word, appreciable, and yet properties in Chester County historically over the past 5 years are appreciating, going up in value of roughly about 4% or so.
For now.
For now, depending on where you're looking, sometimes that's a little bit lower, and yet 4% is actually just these investment properties, and then it's increasing over time, so it's actually like a savings account to some degree, without you adding the extra savings into it, if that makes any sense at all.
It does, and I would say, I'm not a flipper. I hold properties, and so I'm in it for the long run, right? And 20 years, I'm going to have this thing sooner than that. I'll have it paid off, and it'll be pure cash flow, and it will be appreciating depending on what type of property you get. If it's multi-unit, they appreciate at a different rate than like a single family property would.
Yeah, they just appeal to different people.
Yep. Number 3 is it's leverageable. So we're looking off the list we got here. It's leverageable, which means you can buy on margin and borrow against equity. You kind of just touched on that a little bit, but the idea there is that, like, let's say you buy it 20, 30, 40% below its value, you get appraisal done on it, and you can actually take out an equity loan and then go buy more properties.
Another way to think about it is you're borrowing from the bank.
Right.
You don't have to put cash to buy the whole thing outright. So let's say you put 20% down on an investment property, and I've never heard of it, but that you can buy stocks, 20% for one stock, and it still pay you back.
Right.
Doesn't
you
work
got to pay
that way.
100% for it. Not you can't take a loan to buy it. Whereas real estate, you can put let's just call it $10,000 for math's sake, and it's like, okay, well, if you're getting $100 back a month, yet the property was like $100,000, like you're only looking at your return on investment on your $10,000 you put in.
Yeah, that's good. I think that's cool. It's rentable, cash flow.
Yep.
So ideally, in a perfect world, I wouldn't buy anything unless it cash flowed and it was a rental property, right? You want to make money on a monthly basis. Imagine with me, let's say you have a monthly budget of $1,000, right? Where that's all of your expenses. What if you bought a property and that incrementally went down with each property you bought? Maybe someday you can actually live for free.
Yeah,
indefinitely.
Right. Yeah. It's
With
called
money,
passive income.
Yeah, and that's a pretty wild thought for a lot of people who you just save, and then once the savings go away, then what do you do?
That's right.
I don't trust the government too much. Sorry, am I not supposed to say that?
I don't think Social Security is going to be around when we need it, to be honest, especially when you need it. And so cash flow is extremely important, and somebody else is paying down your mortgage, which is great.
Yeah.
So,
Number 5.
Improvable. You can put sweat equity into it and get a lot out of it, right?
Yeah, I mean that's pretty straightforward.
Yep. Next one.
It's deductible, depreciable, and deferrable. Those are all tax benefit words. So essentially, who knows what's going on these days with the tax codes and whatnot, and yet at the same time, you can write off certain things regarding your home or properties, and then that has tax implications and benefits.
Yep, absolutely. And that's really a good way to look at it from a tax shelter standpoint. There's a lot of benefits from the tax perspective.
Yeah, it's not, I wouldn't say shelter as in like, it will take all your tax expenses away.
No.
It's not like that, but it can have some benefits and reduce those.
Absolutely. Number 7 is it's stable, slow to rise, slow to fall. So even though we're talking about a market shifting, look, pay attention to what we're saying over the next couple of months, see what happens if you're thinking of investing. And honestly, if you're going to hold it for 20 years, it hardly matters for the most part.
Yeah.
But, it's not like, do you know what's going on with the stock market right now?
Nope.
Holy cow, if you look, it's like it's gone off a cliff. We just, this week, we've lost a year's worth of gains, like in 2 days.
Are you serious?
Yeah, I'm dead serious.
I need to pay attention.
You need to subscribe to the Morning Brew. I'll have to put out a link on that, but it's an easy, fun, quick newsletter. But yeah, it's crazy. It's like, and so real estate is not like that. It doesn't react that way.
It's slow to rise, slow to fall, but it happens gradually, then suddenly.
Yeah,
right. That's
right.
the other thing. So it's like it slowly change, and then eventually it will change, and everyone will notice.
Yep. The last one is
livable.
That's right.
It is what you would call a real property purchase.
Mm-hmm.
So you can invest in lots of things that aren't real property, stocks, other things, mutual funds.
Yep.
Being that it's a real property, it is tangible. You can actually, worst case scenario, let's say you pay it off, everything goes to hell in a handbasket.
That's right.
And you can move into the property.
Yeah, don't you have a mountain property so that when the zombies come out, you're good?
It'd be a good idea.
Just kidding. He doesn't have. I would like a mountain property, but not for that reason. But yeah, I mean, you can live in it. It's tangible. It's real. Like Bitcoin and all that stuff. Who knows what's going to happen with that? Probably be more and more, commonplace. However, it's real. You can live in it and touch it. So here's why we're saying this: is we would love for those of you that are interested in investing, please reach out to us. We would love to help you get started on your first, second, third plus property. It's not as hard as you think. It's not as scary as you think. With a little bit of help, we've got great resources, some books. We all invest in real estate, so we're experienced in that. We would love to get you in the game. Right?
It'd be fun.
So anyway, with that said, I'm going to let Derek go, or Ducky go shoot some ducks in North Dakota. And, North Dakota?
Yeah.
So great to see you guys. And reach out to us if you have any questions about real estate or getting your home on the market or buying something, and especially investing. All right,
thanks, guys. See you.